The truth about Taiwan Semiconductor Manufacturing Co. Limited. These guys are legendary. If you guys don't know about TSM, they're basically the guys that make all like the chips inside of the iPhone, and they're like just a wholesale semiconductor manufacturer. Like they're in the tech space, and if you go over to the website, you can kind of see nothing about their products, and the reason why is because like a vast bulk of their business goes to like large scale orders to really big companies, and they just make chips, and that's all they do is they make chips, and they do a really great job at it, because they're worth, according to Yahoo Finance, market cap right now is about $275 billion, which is it's a lot. So they do what they do, and they do it really well. If you look at just in general, who makes the components for the iPhone? TSM is really one of the bigger guys because they're the ones that are making like the chipset for it, and they do a pretty freaking great job of it. And obviously they have other clients. But in general, what they do is really simple. They just manufacture semiconductors and chips and stuff like that for computers, for technology. They have sort of like wafers that they'll make, which are again just part of computer chips. Basically, their business is very simple. They make computer chips, and then they sell them to other people who turn them into final products. So they themselves don't really like market or sell anything. They just make sort of like the underlying tech that makes everything work at the end of the day. If you look over on Yahoo Finance at just their general business description, you're going to get about the same technology, the same description. It's pretty fundamentally like they're a solid company, and they do what they do really well. The question is their stock worth it right now, or what's going to happen with it? Especially considering that right now, like Apple is one of their largest clients. They account for, I think it was a third of their sales. If you have a company like Apple, and Apple's got all their stores, right, and that are selling, the products that TSM is a pretty important part of making. These stores are what? They're getting closed because of the virus, and so now all of a sudden you have a bulk of their stores are getting closed, and so if the stores are closed and everybody's like scared about this virus, it's going to lead to a decrease in sales because people can't go to the store. It's going to lead to less money, which is going to very simply put, lead to less orders from TSM to make phones, right? So this is kind of the self-fulfilling loop that we're in that is putting these guys in a little bit of danger right now, and it's not really an optimal situation. Which is interesting because if you look at the recommendation trends, everyone says to buy this stock. So let's first look at the revenue. Like the revenue looks really good. They make $1 trillion a year, and they're growing. They have really nice earnings. Like their underlying business is really strong. But just because of the way they function, if other businesses don't do well, then subsequently they don't really do as well. And to illustrate this point, I want to pull up the chart real quick. And let's do a comparison of TSM to Apple, which is going down pretty hard right now. And I got puts in Apple, and they're up, hundreds of percentages. And so I think we should compare these real quick because it reveals a lot about the actual tendencies of this stock. Awesome. So I've got TSM here in blue, and then AMD here in orange, and Apple in red. The reason I added AMD is because TSM, they don't only serve Apple. They actually have up to 480 clients. So it's like Apple, Huawei, Qualcomm, Nvidia, AMD. I mean, these guys are really the core. They're the basis of a lot of tech companies. It's not like they just have one client, and that's good for them because that means they're diversified. They're in different industries. Obviously, these different industries are very highly correlated because they're all basically in the same industry, which is technology. But I mean, at least they have different clients, right? So one company closing their stores doesn't mean it crush them, but they are the sole supplier of Apple's chips. So that is a really good chunk of their business. So here we can kind of see historically they've been pretty relatively correlated. They go up and they've gone up sort of alongside these big tech companies. And now that everyone's stumbling, the market's this is really where the market's going up. And I think it's kind of reasonable to think that a bulk of what's been happening with them previously is correlated with these big tech companies because they're a tech company, and it's similar industries is going to lead to similar results. And it shows a lot in the actual underlying stock. If we look just thinking about it in terms of like market trending periods, what we have here at the beginning here is basically like this really big bull run. And this is a bull run not just in like Taiwan, TSM, or an Apple, or in tech companies. This is a bull run in the entire market, and that's really what we have, for almost the past decade, right? And now we're starting to enter what? We're starting to enter sort of a recession. We're starting to sort of enter, a down market, and now all of a sudden that we have sort of a down bears. All of a sudden, you've got these stocks going down, you got these stocks going down, you got these stocks going down, and TSM is kind of following the general market. They're following the overall market, and they're doing what their clients are doing, which is having a bit of a pullback because, people are afraid of, whether or not they're going to, be able to travel safely or to not get infected with a disease that could kill them. They're probably not going to be as worried about, iPhone sales, and I think that shows with just overarching people slowing down in the tech sector is because you've got shifting markets, and if stuff starts to go bad, these guys are going to go down like just alongside their clients, alongside everyone else, just based on the surface, looking at the surface. So the question now is what do the financials look like? Because these guys, like on the surface, they seem like to make a lot of money. If you look at the revenue, this here is in Taiwan dollars, so if you want to kind of convert that into US, you're looking at about 3 cents on the dollar. So kind of just divide this by 3, and then it's in thousands. But again, at the end of the day, you're looking at trillions of dollars top line revenue, tons and tons and tons of gross profit, and everything about this company looks really, really, really good. Like they make money hand over fist. And I mean, you can look at their cash flow. Their book value right now is about $10, which is kind of like okay for a $50 stock. But the market cap has just been going up and up and up and up and up and up for years and years and years and years and years and years. Their return on assets is nice. Their margin really is the kicker. They have like a 33% profit margin, which translates into a 0% operating margin, which isn't as great. But it's still, I mean, they do a great job of making money, which is really, really good. The thing that kind of stands out to me, though, is something that's a little bit risky. Is first of all the payout ratio, right? So these guys pay, a 6% dividend, and that's about 92% of their profits, which is, the question is that sustainable during a deflationary or recessionary period? And, I don't think it is. If we look at what they did back in 2008, you're looking at a company that didn't even pay dividends, and they were really just performing a bunch of splits over and over and over again. These are very, very small, insignificant splits. But for some reason, I mean, they're forward splits, which is great, but they didn't really start paying dividends until this bull run started. And the question becomes is like, are they going to be able to sustain these dividends in a recession? And I don't think they will. Another thing we can kind of look at on this chart that we can see is if we have Bollinger Bands, not necessarily to the monthly, but if we add them to the weekly, we can see right here there's a really interesting pattern where it's basically an interior Bollinger Band W setup. And usually with these, like, you want to see the move start to come up like right here, but it doesn't. And I know some of my students, they saw this as a W pattern and they bought right here, and they still made a bunch of money because it went up, but it had this little bit of tumble. And like that's not great. And I think that's probably one of the reasons if we pull up the snipper real quick. Like oftentimes you want to see, this is the W, and your upside on this, you really want to see it, ideally to be basically the height of this right here times 2. So if we just do some quick finger math, we can kind of take this, add it on top of itself, and then add it on top of itself again, and we see that that's basically exactly where it went. So like it actually like had this really nice W setup, and it went essentially exactly where it was predicted to go based off of bottom bounce here, bounce here, bounce here, and then it breaks out, and it worked really, really well. The stock went from 44 to 55, so you're looking at what, 20% there, which is pretty great. 60 at its highs, but the predicted target was probably somewhere around like 57. And so now that it's hit that high, now that it's hit what it was predicted to hit, you see it start to come back down, so you start to retrace. And the question is this going to continue? And is it going to come back down to this like weekly 200? Is it going to go below this weekly 200 because of a down market? Or is it going to kind of maintain up here? And that's where I think the financials come into play and where the underlying stock really starts to shine. So if we go back over here to our balance, we see that basically they have tons and tons and tons and tons and tons of cash, which is awesome. And they have a low amount of inventory, which is really good. A lot of people think that you want to have a bunch of inventory, but if you think about it, like if you've got this warehouse in the middle of Taiwan and it's got like hundreds of millions of dollars of inventory and it's just sitting there doing nothing, like a lot of people see this as an asset, like, oh, look at all this inventory, this is stuff that they can sell and it's great. And like to an extent that's true, but when you have a massive buildup of inventory, what it really shows is it shows a lack of quality management. And the reason why is actually really management. It's actually really simple. Basically you've got sort of one thing that matters most in any kind of manufacturing cycle. And what I mean by that is you'll have tons and tons of different things that go into making a product. And for these guys, we'll call it, you know, a new semiconductor or a new chip. And there are a lot of different components that go into it. And you have a factory, and in this factory, they make all these components. But what's interesting is one of these components, like without fail, in every situation possible, if it is physically, you know, if it exists on this planet, there's always going to be one component. And this one component is going to be one or two components, usually one component. This one component is going to be a bottleneck, okay? And when I say bottleneck, what I mean is the speed and the output of everything in the factory, it depends on the bottleneck, because what happens is you have every single machine here, and if you're not focusing on bottlenecks, what happens is these machines, they produce an intermediary part. These machines produce an intermediary part. These machines produce an intermediary part. And these intermediary parts, they get sent off to the inventory until they can be assembled into final products. So they can be assembled through the bottleneck to actually go out and be sent and sold for, you know, money, right? And they can fulfill purchase orders, right? And so what happens is when you don't, well, first of all, this is how most manufacturers work, is they just produce everything that they can. They work their employees as many hours as they can, and because of that, they get a ton of inventory that doesn't, because it goes to the bottleneck. So, for example, like right now, I film tons and tons and tons and tons and tons of videos, and then those videos get put off in inventory, and then that inventory has to go and has to get edited, right? So my bottleneck example would be like editing, right? And the output of my output, my output example would be like videos. My output is determined not by how fast I can film videos, but how fast they can get processed through the bottleneck, by how fast they can get edited. And that turns into the end result, right? And so with this company, with Taiwan and TSM, what you're looking at is a company that very, very likely is producing a lot of these intermediary parts and not optimizing for bottleneck. So like if I was going to optimize for the bottleneck, the most important thing you can do is have the bottleneck running like 24/7. Because the output of the entire factory depends not on everything in the factory, but it depends exclusively on the bottleneck. And so, like my objectives, right, are to have like editing running like as much as possible. And the reason why is because that's the bottleneck, and that's what determines the output of the system. That's what determines the output into the marketplace. And it's the same thing here with TSM. They have all these machines that are producing all these complicated parts to like actually manufacture semiconductors, which I'm sure is just a crazy complicated thing to do. And you know, when they run everything at once, they're producing a lot of excess inventory. There's two reasons this is bad. The first reason why it's bad is because this inventory ages, right? And so, you know, it decreases in value over time. Like the chips from last year aren't as powerful as the chips from this year, right? That's kind of obvious. But the second reason is when you're focusing your attention on building up inventory, you're focusing your attention on non-bottlenecks, what happens is you have less attention being sent towards the bottleneck. And when you have less attention on the bottleneck, it means that sometimes you have an inefficiency in the bottleneck. Sometimes the bottleneck isn't even running, even though it's the most important piece of the equation. And I think that's why we're looking at this massive buildup of short-term inventory with TSM. I mean, it used to be a lot. I mean, it's literally hundreds of millions. No. That is billions of TWD, which billions of TWD translates into, I guess, hundreds of millions of dollars. And I mean, kind of think about it like this, right? I mean, it's really not a difficult concept. If you have a group and everybody in the group is trying to walk down this path, right? And you have the fastest people at the front, you have the slowest people at the back, and everyone's walking together, but you need to stay together because you're a team, because you're a factory, you have one unit of things to output. what happens is if like the person at the front walks really quickly, eventually they're gonna get so far ahead they can't see this guy in the back, and they're gonna have to stop. And when they stop, it halts production. When they stop, they have to wait for everybody else to catch up. They have to wait for the bottleneck to catch up, and it creates inefficiencies in the manufacturing process. And that's sort of what we're seeing here with TSM, is they're this fast guy out front. They're the ones that can produce tons and tons and tons of chips. They can make, I'm sure they can make the amount of chips needed for the iPhone like 10 times in a year. They're not the bottleneck. They're producing faster than everybody else, and they're at the front of the pack, and they're going super quick. Whereas this is like everybody else. These are the people that have to actually, assemble the product. These are the people, and I mean, with companies like Apple, like they're literally closing down their factories because they don't want people to die. These are the ones that have to assemble. These are the ones that have to market, and these are the ones who have to eventually sell to clients, right? And so these guys, like the companies that they sell to, are themselves the bottleneck, because they can expand. I mean, they've been proven to be able to expand. Look at their numbers; they're freaking massive. And so, because they're so big, like they themselves are not the bottleneck. The bottleneck is sort of their clients, right? And so, this is why I'm scared about this excess buildup in inventory, and also just general like deferred revenues. Because if they're acting as the front guy, they're the bottleneck, and they're in front of everybody else, what's going to happen is eventually they're going to get so far ahead of their clientele that they're going to have to stop. And when they have to stop and wait, what it means is decrease in production. It means people standing around doing nothing. It means, which isn't always bad, but it's bad for extended periods of time, right? It means people, their factories right now with so much excess inventory to the point that them working is creating a liability for them, because now they have to store all this excess inventory. Now they have to figure out what to do with it. Now they have to actually like go out and try to market it to people that are trying to catch up to them. And that's sort of the challenging situation we have here. The way to fix this is really easy. All you do, very simply put, because look, the slowest person on the team, the slowest person in the supply chain, they're going to determine the overall speed if everybody has to always wait on them and if they have to go together as a team. And so what you do, really simple, is you just reassemble the line, and you make it so that the fastest person's in the back, and then you have the slowest dude in the front. Now everybody's trying to push the slowest guy forward faster and faster and faster, and no one passes the slowest guy, and so they're all always together, always on the same path, always like not spreading out miles and miles and miles apart from each other. And now it becomes a lot easier to have a unified team where everybody's pushing the bottleneck to its capacity, and therefore creating the maximum capacity for the underlying company and the relationships they have with other companies. And that's really what we want to see here with TSM. Like, for them to succeed, they need to push the bottleneck, but like at the end of the day, they don't really have control over a lot of their clients. They don't have control over how many iPhones get sold. They don't have any control over or how many Hawaii phones get sold. They don't have any control over how many graphics cards get sold this year. Like, that's not their area of expertise. And so they can be running the factories all day and make tons of excess inventory, but at the end of the day, this inventory is not going to be worth anything if all their clients are like struggling because of an economic slowdown. And that's what I'm worried about with TSM. Because like, if you look at this equation right here, if they're trying to go at like 100 miles an hour, but their clients are struggling because people aren't necessarily, say, buying new graphics cards, or people aren't, like, they literally aren't even able to buy new iPhones or able to, get into different industries. Like, if there's a slowdown in general and there's less overarching, like leisure spending in the computer market, that's going to lead, first of all, to a decrease in the underlying companies. And after those underlying companies decrease, you're going to have sort of a staggered, but still a really big impact on TSM themselves, because they're the ones that are actually powering the underlying technology. They're the guys that are making the stuff under the hood work. And so at first, you're just going to see the really big companies start struggling. You're going to see the ones like the Apples, the A&Ds, and like they're all going down so much, and it actually is kind of nice. I have puts in a bunch of them, and like these are the ones that are going to be struggling first, and then you're going to have sort of this slow movement where eventually people start to realize, stuff's really not going too well for these companies. Could that translate over to TSM, especially in a crash? And that's sort of the place to ask the question,
that you really want to capitalize on here, because if these guys fall, the big boys fall, the tech companies start to struggle, at first you're not going to see a big change in TSM because they've already sold the product and that inventory's been built up for the companies they sell to. But eventually you start to see what? You're going to start to see less orders, which leads to less manufacturing optimization because they have less economies of scale. And as soon as they have less manufacturing optimization, all of a sudden their efficiencies fall, and as their efficiencies fall, what happens is, this goes down, all of a sudden the bottom line starts to go down and the profits start to go down. And that's really what the play is here on TSM, is they are running at 100 miles an hour and they are absolutely crushing it, making billions, trillions of dollars. But the people that are buying their products are about to fall off a cliff. And if that happens, then they're going to follow suit like no one's business. And they'll likely get hurt more because they're operating in a lower margin game. They're operating in a game where they're selling the stuff that makes the stuff. And, that's not going to be as high margin as Apple, where they sell an iPhone for $1,000 and it costs them $300. That is really not the case with TSM. If we take a look over at their key statistics and their annual report, really what we're looking at here is a gross margin of about 48% and then a net margin of 34%. Yes, they make money, and yes, they do a really great job of turning top-line revenue. They're taking $100 and they have 35 in net profit. That's really, 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 really nice. But the question is that going to continue? Is their revenue going to keep coming in? And is confidence in the stock going to remain at a similar pace? Because people are selling the stock, then at the end of the day, it's going to go down. And so that's kind of the question when we go over and we look at TSM. So with that said, I want to pull the annual report to understand sort of at a deeper level what's going on with this corporation. As we go into this, the first thing we're going to see is basically a bulk of their revenue is coming from wafer sales. Bulk of the revenue coming from semiconductor. I mean, they are in a very niche specific industry, and that makes it really a play on the industry that they're in, which is very simply put, the semiconductor industry. And so, if semiconductors go down, these guys are going to be one of the first to eventually feel it, just because of the nature of their business. And similarly, you got to remember, this is a company based out of Taiwan. You got to think the coronavirus and all this international mayhem is affecting them. International trade laws are seriously going to hurt them if they're paying more tariffs to get their goods into America, to sell them to the companies, to sell them to their clients. Or if they're, I'm sure a bunch of the stuff gets sent over to China, gets manufactured there. So you got to think that, the people that are working there, if they're all scared of this disease, that's going to affect them very, very, very quickly. And that's kind of just some natural, this to this to this kind of thinking. But I mean, think of it, it kind of makes sense, especially if you have countries that are closing their borders. It's going to be a lot more difficult for them to actually sell these products, not the manufacturing to end goods for their clients. Saving grace on these guys is they have tons and tons of cash on hand, and they have a lot of really nice risk management, which is honestly really, really, really good, because that's going to help them in kind of an inflationary period. Especially now that rates are zero, that's going to lead to what? It's going to lead to a really interesting little environment with credit markets. And I think that it's great that they have cash on hand, and that's one of the things that could really kind of be their saving grace, and has helped them a lot, so far with their company. That's one thing that I think also shows the validity of this as a long-term investment. These guys know what they're doing, and they manage their capital, they manage what they do. Everything they do it really, really, really well. This is an effective company in terms of just managing their financials and managing the manufacturing process. Even though fundamentally they have some challenges, they really do really well with the management that they have, especially in the C-suite. And so I think looking at these guys in the long term, they look like a phenomenal company, and one that is really well accounted for and very, very well run with some strong leadership. And that shows through a sort of this is a nice report right here. And that's something that I can really, really appreciate. They literally make trillions of dollars. When your company makes trillions of dollars, you've got a nice company right there. You can see sort of deeper in here that they own a lot of equities, they invest in a lot of assets, and that's great. It shows them kind of investing their capital in ways that they think best.
which works really, really, really well. They talk a little bit here more about their financial assets and the hedging that they do on those assets, and also some of their intangible assets. A lot of stuff just based on how they invest some of the excess cash they have, because they do have so much cash just sitting there. They've got like billions in corporate bonds and commercial paper. Like they just have a lot of money. They're a really, really effective large company. And at the end of the day, I don't think they're going to be hurt too much by a decline in terms of economies of scale, just because they're so big and they're serving such a massive market. Like if you think about like the global semiconductor market, it's only really going to grow in the long term. And these guys are really well positioned to take in a lot of that growth from a diversified standpoint. Like it's not you're just investing in one tech company. Like these guys serve 500 or so companies. Like that's a lot of companies, a lot of clients. And sure, a bulk of the revenue is going to come from people like Apple, people like AMD, people like Nvidia, people like Huawei. But they still have sort of a really nice sort of diversification where you're not just investing in one tech stock, you're investing in a company that services sort of the entire industry, and they really are the staple in terms of semiconductor manufacturing. Because when you just think about it, right, like where are you going to get labor like cheap as Taiwan and products like high quality as Taiwan? That's well managed and well done under a reliable company. That comes from TSM, and they're one of the few people in this industry, in the semiconductor manufacturing industry, that really do this at scale. Like you've got companies like Texas Instruments. It's a little bit more specialized though in general computing. It's not as much into consumer cyclical, consumer surplus, consumer leisure spending into this computer tech industry. And I think that's something that they're really, really well positioned to profit from in the long term, because frankly, there are very few people that do what they do. And if a new player entered the marketplace, they would definitely hurt them. But right now, they're one of the only people that really do what they do, because it's a freaking complicated business. And at least they do what they do at scale. Like there are other people that do, but not really at scale as much. These guys really are the ones at scale. And now, with that said, if Apple next year started to internalize their chip manufacturing, started to do things themselves, no doubt the stock would go down 20%, even though the tangible benefits of that might be as much. So you do have that risk, and it's one of the bigger risks is if a big name that is a client of TSM internalizes their manufacturing and changes to a different manufacturer, even though it might not affect the bottom line too much since they do make so much money, at the end of the day, that could really, really hurt the reputation of the stock, and in the short term lead to a lot of hurt a lot of volatility too, that I just really wouldn't want in any kind of long-term portfolio, because that's a lot of risk that you honestly, I don't think deserve to take. If you look, just in what they've done in the past, these guys got hard. They got slammed really, really hard in the dot-com bubble. The stock went from $30 to $7 in a matter of a year and a half. And obviously I think that's a little bit different than right now, because that is an entire market going bust. That is an entire market taking a hit, and that's something that would be sort of difficult to see happen again. Not completely out of the picture, but especially as we start to get out of this recession, I think they're going to be really well positioned, because for something like that to happen, an entire market has to fail. And as soon as we kind of get out of this recessionary period, that's really not something that's going to happen in the tech space. And so they don't really have as much risk as a lot of these tech companies, because they do service so many people. So obviously, like we said, they're going to be highly correlated. They are going to be highly correlated. But this really is kind of a solid fundamental company. They just make so much money, and so few people do what they do, and they have such great management. You can see here the salaries and bonuses are only $150 million, which is the equivalent of about 70 million US. I guess this is US, so that's good. But that's just so small for a company that's $275 billion. And so really the way that they manage this company and the corporate structures and the compensation is really, really, really good. It's great, to be honest. This is a really well done company. And everything about this just screams this is a quality investment. They return, like we said, 90% of their money to investors through the dividend. That's a freaking nice dividend. This is just a really, really nice long-term play. Would I get into it right now with the market as it is right now, with tech as it is right now? No, not a doubt. At least not long. We'll get to a minute whether or not this looks like a nice short swing. But in the long term, this is a really nice company. As long as they remain the predominant semiconductor manufacturer for some of these really big tech companies, I mean, there's really no doubt that they're going to continue to have success. Just, I mean, obviously set of stop losses with any trade. But these guys, they look really nice. And that's really great. Now, one thing I want to look at before we get to the stock, in the immediate short term, I want to see some of the insider trading. So, I didn't know Yahoo Finance did this, but apparently they have this tab over here called holders. And I thought this was just like big institutional holders, but apparently they have a sub tab called insider trade. So you don't even have to go over to the NASDAQ, which is kind of cool. And so, yeah, so no data. Okay, so apparently this hasn't been insider trading. This is an American derivative of the underlying stock, so if we actually go over to their annual report, we can see that their ticker on the Taiwan Stock Exchange is 2330. They're a $1 trillion company on this ticker, which is like just super cool. I never really understood why they always name things by numbers in different countries. It's kind of like hard to remember, but you know what, I'm not going to mess with it. Here, kind of see the same thing, no insider trading. So I guess no one's really messing with it, which is pretty reasonable considering that the stock has kind of just been, staying up and going up lately. But then we kind of get into where it's at today, and this is where we start to see a couple of things that kind of scare me a little bit. Now, the first thing I see here that's a little bit offsetting is you've got like this really big green candle. And like this is really great because it validated that W setup, that interior Bollinger Band W setup, which I didn't draw on here, but we drew it over here, which was a really nice setup. So like the setup worked, and it worked really well. But what it created on the monthly chart was a really big green candle here, and then right after that really big green candle was this really big red candle, and that is usually pretty bad. The reason why it's pretty bad is because it shows like everyone's buying and everyone's selling, and it happens really quickly, and it's sort of like this this green red reversal, and this is not a good reversal to see, especially on monthly candlesticks. That's really where you can start to have some difficulties with these, and so that's what the first thing that was a little bit off-putting for me. And what's also off-putting is immediately preceding this really big red candle right here, you've got sort of this big kind of hammer candle where it's got a really big wick and a really small body, and that's usually an indecision candle that comes right before some kind of reversal, be it on the upside or the downside. So, I didn't really know exactly what to think about it. So I gave it another month, and right now, this candle's almost done. This is the March candle, and this is really the hammer on the coffin where it's validated this hammer candle, it's validated this green-red reversal, and it's gone, and it looks like it's going to close red as the market closes red. I mean, there's some pretty harsh stuff coming out this week, and that's really where the play comes in, I think, in the shorter term. With TSM. Now, with that said, before we get to the short term, I just want to reiterate, this is a really nice stock. In the long term, this is a really solid company. And like, there's no doubt in my mind that after this crash happens, they're going to recover, and they'll be probably a $250 stock in the span of the next 10 years. Like, without a doubt, like, they're a nice company. As long as no one comes in and steals what they do as a company, like, these guys are going to prosper in the long term. But right now, this looks like a pretty nice play to make. You also see right here on the weekly candle a really big hammer candle. It honestly looks almost exactly like the play that we made in Apple. It's a very similar setup. And basically what we're looking at here in terms of a target is I want to see these guys hit the monthly 50 moving average. I want to see these guys at about $38, and more aggressively 30. I think, but in the shorter term, like, I think conservatively this is like a $42 stock pretty easily. And so you kind of have a couple of different ways you can play this. The first one is to look at it as a MACD play and to see sort of the weekly and say, okay, well, they crossed over on the weekly and they're coming on this downtrend, which is super valid, super cool. The reason I didn't immediately jump on the weekly MACD play is because they've had a lot of like weekly MACD setups before, where the stock like crossed over on the weekly MACD, but then it actually went up a bunch. And so that's why I wasn't immediately super excited about the weekly MACD play. So then I kind of like, first of all, I added two things. The first thing I added was stochastic. The second thing I added was Bollinger %B to kind of really look at how this looked on a monthly basis, because I see this more as a monthly trade. It's like a 2 or a 3 month trade, if you ask me. And that's where things start to get interesting, because the last time they were this extended, was really kind of in the 2000s, and it happened. They had a high percent B in '05, and then they had a high percent B in 10, where they had subsequent downtrends afterwards for both of those time periods where they went. Looks like here they went from 9 to 9. It was 9 to 8. It was a pretty small downturn. Here they went from 12 to 12, which is a pretty small downturn. But this is where we start to have an interesting result here, is because this is really not only do you have a high percent B, a crossover on the stochastics, and a very, very, very close to a crossover on the MACD on the monthly, but you also have the start of a bear market and an economic recession, and that is an inverted yield curve. I guess was kind of right around here in 19. And so that's really the play here, and the reversal pattern here. And what's validating the reversal pattern here is the overarching market that these guys are in, and that's what makes it a really compelling play. So I think conservatively, like, we're looking at a $42 target. Aggressively, these guys could go to like 35, and depending on how far the market corrects in the next couple of months, it could go lower. But really what you're looking at here is a play in the short term, about a 3 to 4 month trade, based on like tech slowing down pretty hardcore because people are freaking out about this virus. They literally aren't even like leaving their homes to go to restaurants because they're so scared about it, which is a very valid concern. And so let's go over to the options here. If you're doing this on straight equity, what I would do is actually really, really easy. Basically what you want to do is, short, and then stop loss on this trade is at like $55. So you're risking about $3 on a $52 stock, and for the mathematicians out there, that's about a risk of 5%, 5.7%. So right now, I think 5% risk on this is pretty reasonable. If you're doing this on a straight equity play with a target of 42 conservatively, you're looking at an upside on this trade for those mathematicians out there of about 23%. So just really simple numbers here. You got about a 4.5 to 1 risk reward ratio, give or take, 4.2 to 1 risk reward ratio, which is really, really nice for a short play on here. Like that's phenomenal. But I would like to make a little bit more than 20%. So I'm going to look at the options expiring TSM, assuming that this setup validates. And with the same exact stop loss, like same stop loss, like these guys get to 55. I don't want anything to do with them because they closed above this hammer candle. So I would stop out of these guys like instantly at 55, no matter what the position is. I'm thinking like though Junes I think are going to be sort of our Goldilocks time zone where it's not too close, it's not too far. We could probably get away with Mays, but just to be safe, I think we're going to go with Junes. The Junes are 25% more expensive than the Mays. So if you're getting in this trade, you could, I think, like, what's smart to do, maybe do like a quarter of the position in Mays, a quarter of the position in Junes. But let's pull up our calculator real quick and figure out kind of which strike price would make the most sense, assuming we have about, a $42 target on these guys. It's not that difficult. We got basically 2 strike prices to choose from. It's the 50 strike price and the 40 strike price. And I guess the 55 strike price, since they're at 57, or I guess they're at 52. Okay, yeah, they're 52. Okay, so basically you can pay $1.50 for 40. Or I'm gonna look at the Junes just because the Junes are a little more safe. These are about $4, I'd say, to get Junies. We'll call it $4.20, maybe $4.50. I'd say $4.50 conservatively. You're looking at $4.50 for the Junes, at 50 strike, and you're looking at about $3 for the 45 strike. So if we have a target of like $42, we're looking at an inherent value on the 50s at about $8 a share, and that's going to be a net return of about 100%. If we're looking at the 45s, we're looking at an inherent value of about $3, and that's going to give us a net return of about 0% because that's going to match the premium, which isn't great, and that's sort of where we get into the nuances of this trade. And the reason why is because to make a lot of money on this trade in terms of like straight options, I mean, if you're not going to do equity, you can do equity, and like I said, you can make about 20% with a 5% risk, which is pretty solid, 24% with a 5% risk. The real play starts to come in if they can drop below these moving averages. If they can get to like 38, if they can get to like 35, and even if it only is for a short time frame, if they can get to 35, that's where this play starts to really kind of make a lot of money. If we look at the 50 strikes, that's going to give it an inherent value of 12, which is going to be a 3x return on your investment. If you look at the 45, it's going to be an inherent value of 7. That's going to give you about a 2.2x return on your money. And that's kind of where a sweet spot is in the short term. Like this trade, you can make about 200 to 300% on it. If it goes below this moving average, which I think is a pretty reasonable thing for it to do by, July, I think is the expiration on these. June. No, these are July. Yeah, July. July is, I think, the sixth month. And I think that's pretty reasonable to see. Let me just. So that's going to give us really a really solid chunk of time for these guys, because you got to like 7. I think it's pretty reasonable to say that they could drop pretty hardcore. If the market drops hardcore during this time frame. But with that said, you do need a lot more volatility to make this trade work than with most trades. And it looks like the options are kind of pricey. The one thing that can kind of be the saving grace for these guys is if like the Taiwan dollar explodes a bunch, it's probably going to hurt their U.S. Equities, and so we'll kind of see how monetary policy changes. I don't think that's really going to be a big deciding factor. Really, the question is, in the next couple of months, can they get below this 50 monthly, which is the equivalent of the 200 weekly? And I think there's a pretty reasonable chance that they do, and the reason why is because if these guys go down and if they consolidate, what can happen here is actually really interesting, and this is going to kind of lead up to a subsequent play that you can make with this company, which is a pretty freaking nice play. And really what you're looking at is a play where the stock kind of has this shoulder right here, has this head right here, and then has another shoulder, and then in like 2021 it has this really big drop. And that's kind of where this supplemental second play, and this is where I think most of the money really is going to be made with this company, is if this turns out to be a head and shoulder setup, this is going to be a really, really nice stock with a lot of money to be made. You're looking at basically a $52 head to about a $38 shoulder line. That's give or take, 40 to 50, like $14 right here. And so you turn that $14, you do 38 minus 14. That's going to give you 28 minus 4 is 24. It's going to give you a target right about here on that head and shoulder setup. And that's where I think a bulk of the money to be made on this investment is it's not necessarily in this small retrace right here, though I will definitely, I'm thinking, we'll get to that in just a moment. Bulk of the money to be made on this trade is actually, if they turn out to be a head and shoulder setup, then you can short right here. You can get, probably I would say 3-month puts on these guys. And if you look at sort of puts that, and when that happens, you're looking at a $14 movement in the price. Versus right now, them being at 50, going to like 40, that'd be about a $10 movement. And it might not sound big, but that extra $4 is really, really important if you're looking at trading the options here, because what it does is it turns a trade that makes, we'll call it 3 months. So we'll look at, I guess these Mays are going to be a little bit better representative. It turns a trade that makes $3 turn into $10, which is about a 3x return, into a trade that makes $3 turn into $14. And so that would be 14 by 3, about a 4.5x return instead. And that's going to be a lot better. That's going to give you about an extra 150% to play with in your margin. And that's going to make it a much easier trade to make. And that's, I think, where the big play is here on TSM. In the short term, honestly, you could probably double your money on this trade, but I don't really take many options trades that only make 2 or 3x returns. If I have money to burn, then by all means I would short these guys with a tight stop loss, or buy shorter term options, or 4-month options with a tight stop loss. You're really looking at a max loss on these options of about $2 in inherent value. And looking at the difference between these strike prices, these are a $5 difference in strike prices, and it's only about a $1 difference in the option price. So in all reality, I think that the most you would lose on this option trade, assuming that it moves quickly without any time decay, without any major time decay, is about, I would say, 25% on 50 strike price. So you're risking, I'd say, about 25% here to make about 2.5x, which is about, say, 250, 300%, which is pretty solid. That's about a 1 to 10 risk reward, but it is kind of, it's an options play, so it's kind of riskier. But for me, it's a solid trade. So I might put a small amount into it, but probably not that much, just because it's not really like a 6x return, a 7x or 10x return. Where that could happen, though, is if this turns into a head and shoulder setup, that's where you could really start to see a lot of money made on this stock. And I don't want to see this turn into a head and shoulder setup, because this is really a nice company. This is a phenomenal company. But I mean, the same thing can be said about Boeing, and Boeing did the exact same thing. They went up a boatload. They freaking went from 180 to 460 in the matter of like a year, and then they had a freaking head and shoulder setup. And I'll kind of draw it for you so you can see it, because I think it might help you get better investments in your future. So you've got a position where there's this huge run up, and it turns into a head and shoulders, and then it goes down a bunch. And like the deal is like, yes, okay, you can make money shorting it from here to here. I mean, you can make a pretty solid chunk of money. That's give or take a move from 440 to 340. That's about $100. That's about a straight equity play, 25%. Do that with options. If you look at the options on Boeing, you're looking at a net of about $30 down, $100 out. That's about a 3 or 4x return, which is what we're kind of seeing here with TSM. Like, that's a pretty nice return. But really, a bulk of the money to be made here is when it actually, or if it actually completes this head and shoulder setup. And that's where you're going to start to see these profits, where you take this right here, and then you just kind of do some quick finger math, and you add it down here, and you kind of get your price target. And the market has crashed, and they've gone below that price target, which is pretty awesome. But that's really where the bigger play is. And so you buy your puts, or you short or whatever, and it goes from 300. I would say probably the entry point on this trade is at 314. It goes from 314 to conservatively 214. That's a $100 profit. It's the same $100 profit, but it's a $100 profit on a stock that's $100 cheaper. And so it's from a straight equity point of view, you're looking at a gain of about 45% on a short. And in terms of these options, you're looking really at, I would say these options are obviously differently priced than when it was originally. But I mean, you're looking at shorter term contracts here, and I would say pretty easily you could turn this into from 175 to 75. You buy out of the money puts on this, and you're looking at a return from about $7 turning into about $50, which is $50, $60. I mean, it's about a 9x return on that investment. And so that's really where the money is yes, you can make money shorting the head, but a bulk of the profit here is going to be if the head and shoulder setup validates itself. And if it does, then, I mean, you better believe that this is going to be a setup that can create about a 10x return, which is really, 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 really nice. Just trading a little bit further out of the money, which you're going to be able to do because, like right now, it would be kind of difficult to trade out of the money on TSM. But if it turns out to be a head and shoulder setup, you can trade out of the money puts at like 30-30. Or 30, like 32.5, or even 30, because you're looking at if this becomes a head and shoulder setup, you're looking at it from 58, give or take conservatively 55 to 35. It's about $20. So you subtract 20. I mean, you're looking at about a $15 target on this stock if it does do head and shoulder. I think conservatively maybe it'll go to like 20. So those 30 strikes, I mean, they'll obviously go up a bunch. But yeah, I mean, you're looking at it basically. I would say these strikes will go up by a factor of about 5. So maybe you put down like $4 if the setup validates, and then that turns into I would say by like February 2021, maybe like March 2021, maybe or 2022. Yeah, sorry, late 2022 or 2021. Maybe like 2021 January's. I mean, you're looking at a target here of give or take $20 if it validates, and that's really going to be where you see this turning into a couple of bucks into, I would say, a $10, and that's going to be about a 10x return on that investment, which is pretty sweet. So it's got to validate, and assuming that it validates and control the setup, you've got a really, really nice play here in the immediate future in about a year or so, and that can turn into some pretty nice cash. What I would do is I would set a notification in your TD or your Thinkorswim or whatever. If these guys hit like 35, I mean, they're going to 20 pretty conservatively. So I think that's probably the biggest takeaway from the year, is assuming that this validates head and shoulder setup and it does consolidate for about 6 months or so, this position could be worth really a solid chunk of change. Even though the company is amazing, if the industry slowly decays away and it slowly does this thing where it kind of chills out and it fails like Boeing did, I think over time you'll start to see confidence in this company erode away in the short term, and that'll lead to a really nice opportunity to short them. And then, like, I would love to buy these guys and put them in a long-term portfolio because they pay amazing dividend. They're a great stock, great company, and in the long term, after they crash and everything, it looks like it'd be a phenomenal investment to make, assuming there's no other big players in the industry. So that's kind of the big takeaway in the short term and in the long term for Taiwan Semiconductor manufacturing. Hey, this is John. I want to thank you so much for making it to the end of the video and hope you get a ton of value from the stock that we just broke down and hopefully learned a lot about them. Now, what's cool is if you have an investment that you think could look really, really nice, or maybe it's a potential investment that you're on the edge about, or maybe it's a stock that you're holding right now that you're just a little bit curious about, or maybe you want to get an outside perspective on it, what's cool is if you leave a comment down below with the ticker of the stock, I'll actually put it in Queen for a potential new video coming out. Now, make sure you also subscribe so that when those new videos do come out or when these new stocks do come out, you'll be able to get, YouTube will know to send you the stuff, and if you click the bell, you'll actually directly get a notification so that you don't miss any of the new investments that we break down on this channel. Now, what's also cool is if you want to learn how to outperform 99% of investors and radically limit your downside, even if you can't pass a finance test for your life or have nothing to start with but a few spare bucks, I want you to open up a new tab right now or go to a new browser, wherever you are, and I want you to go to stockmarketsecretsexposed.com. And inside Stock Market Secrets Exposed, you get instant access to a course I used to sell for thousands, a very, very high-level seminar I gave. The students literally go through and in their first month make 5, 6 figures. And I can't guarantee anything, but I know for a fact that this stuff works and it's gold. What I want to do is I want to give you this course I used to sell tons. I want to give it to you completely for free so you can learn the top 35 secrets that you can use within the next week to really, really crush your portfolio, really double it and radically limit that downside. So if you want instant access to that, what you got to do right now is open up a new browser tab and go to stockmarketsecretsexposed.com and I'll send it to you for free. Okay? Sound cool? Sound fair? Thank you again so much for watching, and I will see you either in another video on here or over in the master class. Thanks. Bye.